Hello and welcome, everyone. Thanks so much for joining us. We are going to give it just another minute or two for more folks to join on. We had over 1,000 people register for today's session, so we want to make sure everyone has a chance to join, and then we will get started momentarily. Thanks for your patience. All right, it looks like we've reached critical mass, so we are going to go ahead and get started. Thanks to everyone for waiting there for a few minutes. We had over 1,000 people register for today's session, so we just wanted to make sure everyone had a chance to get here before we got things started. Just a few housekeeping notes before we proceed. First of all, this workshop is being recorded, and everyone will receive a copy of that recording following today's session. So if you get distracted at any point or have to step away, not to worry. Again, you will receive a copy of the recording from today's webinar. That said, if you do have any questions throughout the presentation, I encourage you to put those in the Q&A. I will be pausing periodically to see if I can answer any out loud. And I'm also joined by my amazing colleague, Dylan, who leads our customer support team. She's a student loan expert, and she's going to be trying to answer some of those directly in the Q&A throughout the presentation. So we really want this to feel as interactive as possible. We can't guarantee that we're going to get to all the questions that are submitted, but we will do our very best. And if you need to enable closed captioning or live transcription during the webinar, I'll be posting a link in the chat with instructions on how to enable this feature on Zoom. All right, so a quick look at the agenda that we're going to cover here today. We're first going to do some brief introductions of who we are here at Savvy, myself, and the student loan benefit that is provided to you all through SEIU member benefits, one of the nation's strongest member benefits platforms for union members associated with SEIU. So we're really excited to be able to provide our expertise, tools, and services to the community of student loan borrowers within the SEIU family. And then we are going to dive right into the meat of the presentation. We're going to talk about income-driven or IDR repayment plans, what they are and how they can be a powerful way to help lower your monthly payment. We're going to talk about PSLF or Public Service Loan Forgiveness. This is one of the biggest and longest standing forgiveness programs out there. So we're going to walk through exactly how you can qualify and apply for that program and hopefully reach that finish line within 10 or more years. And then we're also going to talk about some of the more recent but major policy updates in the world of student loans. A lot has been happening, as it always does with student loans, and I know how difficult it can be to try to follow all of that on your own. So I'm going to break down the most important things that you need to know right now and any actions you might need to take. And then we're going to wrap things up by showing you how to get started with Savvy, whether it's getting into your account, creating an account for the first time. We'll explain exactly how Savvy works and how it can be a powerful tool in helping you navigate through each and every step of these complicated plans and programs and processes. All right, so my name is Lindsay Clark. I'm the Chief Borrower Advocate here at Savvy, and I'm a student loan borrower myself. I have a little over $200,000 in student loan debt. Now, if you've ever seen a webinar or heard me speak before, you've probably heard me say this, and I do it at the beginning of every presentation because one, I hope it makes some of you feel better about your own situations in comparison. Hopefully, you have far less student debt than I do. But two, because being a student loan borrower impacts how I communicate about these topics. I wasn't always a student loan expert, and I know firsthand how overwhelming and complicated these programs can be to navigate on your own. And so my goal here today is to not speak at you and recite information that you could easily get from the Department of Education website, but to explain these programs and topics in a way that's easy to digest and understand and really makes clear the path forward and any actions you might need to take to help yourself achieve the best outcome possible for your personal student loan situation. And while, I'm talking to all of you, really today is about making sure that you leave here knowing what's best for you personally. Now, I work for a company called Savvy. Savvy is a social impact technology startup based in Washington, D.C. We were founded by student loan experts and advocates who've been fighting on behalf of the borrower for more than 2 decades. And they realized how difficult it was for borrowers to navigate some of these federal programs like income-driven repayment or public service loan forgiveness on their own. And so they decided to do something about it. And they developed Savvy as a technology platform, kind of like a TurboTax for your student loans, but also a human service, okay, to help borrowers like you and like me not only better understand our student loans, but to navigate successfully from start to finish and reach that finish line, right? When so many borrowers in the past have not. Uh, and we try to do that by identifying as much additional savings as possible on a month-to-month basis through things like income-driven repayment plans, right? Our goal is to make the experience of being a student loan borrower a better one, because I think we can all agree it's not great. And one of the ways that we do that is by putting you, the borrower, first. There are a lot of companies and entities in this space that put your student loan debt first. They either make money off of that debt, they service that debt, right? Manage and collect on it, okay? Their priority is simply the debt. And that's not our priority here at Savvy. It's actually you and the outcome financially for you around your student loans. So our goal today is to really help educate, inform, and ultimately empower all of you to achieve that best outcome possible. Which brings us to why we are here today, because Savvy has had the pleasure of partnering with SEIU member benefits since, I think back to 2018, almost 2019. All right, really, really early on in the life of Savvy, at least, to be able to provide SEIU members and their family members with access to our tools and resources. Savvy provides student loan benefits through these exclusive partnerships. So, not just anyone can get access to Savvy. We work with over 500 plus companies, unions, membership associations, and organizations across the country. You can see some of them on your screen right here to be able to provide members of their community, employees, you name it, with access to our resources. And just to emphasize, it's not just for you, the member, it's also available to any of your family members as well. And we take that sort of loosely, right? So it could be immediate, it could be extended family. Our goal is to make sure that anyone in your orbit is getting the assistance they need if they are also struggling with their student loans. So I'll show you a little bit later on in the presentation how you're actually able to invite any friends and family from your Savvy account to be able to access their own Savvy account, at the end of the presentation. Our goal ultimately, though, is to make sure that, again, each and every one of you, right, at that personal individual level, is able to achieve the best outcome possible for their student loans. And that's exactly why working with SEIU member benefits has been such a powerful player in helping us do that. All right, with introductions out of the way, we are going to dive right in. And first up, we're going to talk about income-driven repayment or IDR plans. So, what are income-driven repayment plans? Well, before I go any further, let me just back up a little bit and give some basic context as to how repayment on your federal student loan works in general. So when your loans go into repayment for the first time, okay, usually after you've graduated, but you don't have to have graduated for them to have gone into repayment. Usually you'll have about a 6 month grace period right before that first payment is due. And you'll get that first payment in the mail. And that first payment amount, okay, and for many of you, it might have been a shock. It's usually pretty high, is reflective of you being put automatically onto what's called the standard repayment plan. Okay, that is the automatic standard go-to repayment plan for any borrower and their student loans entering repayment. Okay. And that repayment plan, all right, is pretty simple. It bases that monthly payment on two things and two things alone: how much student debt you have, okay, and a 10-year payoff horizon. All right, so I'll use myself as an example with someone with a little over $200,000 in student loan debt, right, and a 10-year payoff horizon. That comes out to about a little $1,800 or $1,900 a month, okay, for that payment on the standard plan. Now, I don't know about you all, but that is definitely not in the realm of what I can afford personally, okay? And many borrowers felt the same over the years. So the Department of Education decided to introduce a different way of repaying your student loans. Okay. And those are called income-driven repayment plans. And instead of basing your monthly payment on how much student debt you have and that finite 10-year payoff horizon, okay, income-driven repayment plans base your monthly payment on two entirely different things: your income and your family size. So you could have $500,000 in student loan debt. It wouldn't matter if you're making less than, let's say, $25,000 a year. You could qualify for as low as a $0 monthly payment. Okay. And it's sort of a sliding scale from there based on your income. If your income's higher, that payment amount is higher. If it's lower, that payment amount is lower. And I'll describe how those work in more detail in just a second. Before I do, I think it's helpful to just understand structurally that income-driven repayment, or IDR, is sort of the umbrella descriptor term, okay? And there are currently three types of income-driven repayment plans available for borrowers to enroll right now. That is the pay plan, PAYE, which stands for pay as you earn, IBR, which stands for income-based repayment, and ICR, which stands for income contingent repayment. Now, many of you might be familiar with the SAVE plan. Many of you may still be on the SAVE plan forbearance. We're going to talk about what's going on with the SAVE plan when we touch on the policy updates later on. But the SAVE plan is not available for borrowers to enroll, nor will it become available again. So that plan is ending. And again, we're going to talk about that a little bit later on. So there are currently these three plans, okay, that are available under income-driven repayment. Now, we're not going to go into the weeds on the differences between these plans here today. A lot of it comes down to your disbursement date, your loan type, things like that. The great thing about the Savvy tool is that it's able to identify for you, based on your personal information, which plan you're going to be eligible for and which will be the best for you. Okay. But they all generally work the same way. They cap your monthly payment, okay, at anywhere between 10 to 20% of your discretionary income. Now, what is discretionary income? Well, part of your income is set aside to cover the cost of living, all right? And the leftover amount is called discretionary income. And this is what your payment is based on. So I'll give you an example. Let's say you are single, okay? So you file your taxes as single, you have no dependents, and you have an income of around $52,000 a year, okay? That monthly payment on an income-driven repayment plan is going to come out to around $160 a month. Now, for every child dependent that you have, that's going to typically lower that monthly payment by about $50 per child. Even unborn child dependents count. So if you become pregnant, you can resubmit your application noting that unborn child dependent, and that can lower your monthly payment. And like I mentioned before, it's sort of a sliding scale from there. So the higher your income, the higher your monthly payment. The lower your income, the lower your monthly payment. Okay. And that monthly payment can be as low as $0 a month, depending upon if your income is low enough. Now, in order to enroll in an income-driven repayment plan, right, because you're automatically put onto that standard plan, so you need to switch right into an income-driven repayment plan. And to switch, the process involves an application. And that application requires that you attach supporting documentation attesting to your income. This can come in either the form of your most recent tax return or a pay stub from the last 90 days. This gets submitted to your servicer. Okay, so your servicer is the company that has been assigned to you to manage and collect on the payments of your student loans. So these include Mohila, Aidvantage, Ed Financial, Nelnet, right? Those might sound familiar to you. That's your servicer. Okay. Your servicer reviews the application and says, okay, Lindsay, you're going to be on the pay plan and your payment is $160 a month. And it locks in that payment amount for 12 months. Okay, so a year. Now, 12 months comes and goes, and you have what's called a recertification deadline. And in order to maintain yourself in that plan, okay, and continue on that pay plan, every 12 months, you will need to resubmit a new and updated application with updated income documentation, okay? And the servicer will do the exact same thing again. They'll review the application and say, okay, Lindsay, you're on the pay plan and you are now paying $185 a month, right? The implication being, based on any fluctuations in your income or family size from year to year, your payment amount could also fluctuate up or down. Okay, because it's based on that income and family size. It has nothing to do with how much student debt you might have. Right? It's important that you make sure that you don't miss that recertification deadline, because if you do, you will fall out of the income-driven repayment plan and be put back onto that standard plan. Okay. And for a lot of us, that standard plan amount is significantly higher. So you want to make sure that you are aware of when that recertification deadline is. Your servicer usually notifies you, but also this is what Savvy helps borrowers to make sure they don't miss. Now, when it comes to these income-driven repayment plans, you're also eligible to have the remaining balance, okay, on those loans forgiven after 20 to 25 years of payments, okay? Now, when we say remaining balance, that is your principal balance and interest, the whole thing, all right? And we all know how much interest accumulates on these loans, right? So all of it gets forgiven after 20 to 25 years worth of payments. Now, how long you pay for, right, whether it's 20 or 25, depends on a few factors like your plan and your loan type. For example, you'll see here the pay plan is for 20 years. The IBR, it's 20 years if you borrowed after 2014, 25 if you borrowed before, and with ICR, it's 25 years. Now, when it comes to this forgiveness, no application is needed to receive it. It's actually processed automatically after you've made the required number of payments. Okay. Now, just to be clear, this type of forgiveness, what's called income-driven repayment forgiveness or IDR forgiveness, is different than the forgiveness we're going to talk about on the next slide, which is public service loan forgiveness. And that is after 10 years for those who are working for a qualifying employer. Okay. So I just don't want anyone to get confused or concerned thinking, I thought I was 10 years and they're hearing 20 to 25. This IDR forgiveness would be for someone who is not eligible for public service loan forgiveness, all right, who does not work for a qualifying public service employer, and so therefore can only rely on income-driven repayment forgiveness. All right. Let's see. I see some questions coming through here. Let me see if I can take some of these out loud and help Dylan out here. All right. I see some questions on PSLF, which we are going to get to in just a second. So that might help answer some of the questions that are coming through. Um, when it comes to Parent Plus loans, we're going to talk about those Parent Plus loans more in the policy update section. Parent Plus loans can be eligible for income-driven repayment. However, they must be consolidated and they have an important consolidation deadline, actually the most important consolidation deadline ever, coming up at the end of this month. You must consolidate those Parent Plus loans in order to retain access to income-driven repayment. So the answer is yes, you can, but you're going to need to take action in order to be able to do that. Another question I saw come through is IDR forgiveness taxed. So it was tax-free up through the end of 2025, and starting 2026 at the federal level, it can now be considered taxable income. So yes, it can be. All right, I see some questions coming through on SAVE. If you can hang tight, again, we're going to talk about the SAVE plan and all that stuff at the policy update section. There's a lot going on there, I know. Let's see if there's any other on IDRs. Okay, yep, it looks like they're all PSLF. So hang tight, guys. We are going to talk about that right now. So public service loan forgiveness, or PSLF, is essentially full forgiveness on the remainder of your loan balance, whatever that may be. It could be $5,000, it could be $500,000. It doesn't matter. Tax-free. So this forgiveness, PSLF, is always federally tax-free, okay? Whereas IDR forgiveness, as someone had just asked, can be considered taxable income, okay? PSLF, as it was written into law, is tax-free in perpetuity forever. Now, you can get that remaining balance forgiven, okay, after you have made 120 qualifying payments. Now, if you could see me on video right now, you could see that I'm saying qualifying payments in major air quotes because the devil is really in the details as to what constitutes a qualifying payment. And it really comes down to satisfying these three things that you see on your screen right here simultaneously. So let's start on the left-hand side with number one, qualifying employer. You must work for either a government organization at any level, federal, state, local, or tribal, or a non-for-profit 501(c)(3). Okay. The only stipulation here is you must work a minimum of 30 hours or more per week. However, you can combine multiple or part-time employment to qualify. So let's say you work part-time at a nonprofit 501(c)(3) hospital, and you work part-time at another nonprofit 501(c)(3) hospital. And combined, you work 30 hours or more per week on average. You can qualify for the program. Again, so long as that average is over 30 hours and so long as the employers that you're combining are all qualifying. Okay. Another thing I will say about employment is that it is retroactive going back to October 2007. Why October 2007? Well, that's when this program, PSLF, was actually written into law, okay, under the Bush administration. Now, because it was written into law, it's made it one of the most protected federal student loan programs to date, okay, because it means it would require an act of Congress to ever change or reverse it. All right. So for those who might be concerned about the future of PSLF, let me assure you that it is not going anywhere. And generally, it's seen as a pretty bipartisan program. Okay. But when it comes to employment, all right, any qualifying employment that you've had going back to October 2007, okay, is fair game for the program, right? Unfortunately, any qualifying employment before October 2007 is basically irrelevant for the purposes of this program. So the clock starts October 2007, okay? So if you're just finding out about this now, and you've been working for a qualifying employer for, over a decade or more, right? That period of time is able to count again as long as it's October 2007 to present day. All right. And you could have worked for multiple employers. In fact, most borrowers who actually cross the finish line for public service loan forgiveness have at least two or three qualifying employers that are contributing towards that qualifying employment, all right, over the course of their career. So that's number one, qualifying employer. Now, number two, you have to have a qualifying federal loan. And the only types of federal loans that qualify are what are called direct federal loans. Okay. Easiest way to tell if you have a direct federal loan is it will literally say the word direct in that loan title, or it might say DL, which stands for direct loan. The direct loan program is a federal loan program that began around 2010. So if you have federal student loans that were dispersed to you from 2010 to present day, there's a good chance they are direct loans. However, if you have federal student loans that were dispersed prior to 2010, okay, or you have a Parent Plus loan, all right, you probably will need to consolidate those loans into what's called a direct consolidation loan in order to qualify. So if you have one of the older federal loan types known as FEL, FFEL, or you have a Parent Plus loan, you can become eligible for PSLF, but you need to consolidate that loan, okay, into a direct loan first in order to be eligible. All right. So there's a pathway for you there, but you must take action. And one of the great things about the Savvy tool is that when you sync your loans, we're going to be able to identify whether you have a FEL or Parent Plus loan and whether you need to take that extra action of consolidating, and we assist you with that part of the process. So we make sure that you're eligible going into it. Okay. So that's number two, you have to have the qualifying loan types. And then number three, you need to be repaying those loans on a qualifying repayment plan. And the only types of repayment plans that qualify are income-driven repayment plans. It can be any one of the three that we just talked about, pay, IBR, or ICR, okay? But you must be making that payment on time and for the full monthly amount. So you basically need to make 120 payments while meeting all three of those requirements. All right. So each payment needs to be made while you're working for a qualifying public service employer on your direct loans and while you are enrolled in an income-driven repayment plan. After which, right, when you reach 120, the remainder of your balance, that's principal and interest, is forgiven. Okay, whatever that amount may be. All right. And again, it is not taxed at the federal level. Now, I want to clear up some common misconceptions about these 120 qualifying payments. First of all, they do not need to be made consecutively. Okay, you just need to make 120 total cumulative qualifying payments. So let's say you worked for a qualifying employer for 2 years and had direct loans and were making payments on an income-driven repayment plan, and you accumulated 24 qualifying credits. Okay. And then maybe you left to go work in the private sector or you took some time off. Nothing happens to those 24 credits. They simply pause, okay? And if you were to ever resume your eligibility by working for a qualifying employer, it doesn't have to be the same one, it can be any qualifying employer. You can resume accumulating those credits to 120, okay? So again, does not have to be consecutive. You just need to reach 120 total cumulative qualifying payments. Now, that being said, you can only receive one qualifying payment credit per one payment per one calendar month, meaning you can't double up on payments and get double the amount of credits, all right? Or you can't make a big lump sum payment and get more credits than you normally would. The easiest way to think about it is this. In any given calendar year of 12 months, the maximum amount of qualifying PSLF credits you can receive is 12, one a month, okay? So if you have to get to 120 total, right? You can only get 12 a year. Okay, you're all very smart and can do the math. That's 10 years minimum, right? Before you'd be eligible to receive forgiveness under this program. And that's why many people describe it as a 10-year program. However, I would discourage you from thinking about it around 10 years, okay, and time served, because it doesn't just come down to time served. I can't tell you how many borrowers Dylan and I have worked with who have worked for a qualifying employer for 2, 3 decades, if not more. However, they were not making those qualifying payments and satisfying those other criteria. Okay. So it doesn't really matter about the time. It could take you 15 years to reach 120. It could take you 20, right? But the minimum amount, all right, it's not going to take you any less than 10 years is the point here. Okay. You can't get there any sooner than in 10 years, but it does not have to be consecutive. Now, how do you apply for public service loan forgiveness? Well, there's one form and one form only for this program, and it's called the Employment Certification Form. And you're likely going to have to submit this form multiple times over the years as you are progressing towards that 120. This form essentially needs to get signed off by you, the borrower, okay, with your personal information and your signature. And then it needs to get signed off by your employer or employers. Any current or previous employers you may have had that you wish to qualify towards the program. All right. Usually it goes to someone in HR or with access to employment records at that employer who will verify the eligibility status of that employer. They will verify the dates of your employment, or if you are still working there, that you worked an average of 30 hours or more per week, and then they will sign off. And then that form gets submitted to the Department of Education. The Department of Education will review it and say, okay, Lindsay, as of today, March 18th, when the form was signed, okay, you have 86 qualifying credits towards PSLF. All right, so I have 86 as of March 18th. Now, every year thereafter, we recommend, okay, it's recommended that you submit another employment certification form for your current employment, all right, so that you can bring your certification of credits current, right? So you can certify the past 12 months of credits and bring that total closer to 120. We recommend doing this early and often. So if you are a year into working, you can submit that form. If you are a decade or more into working and have not submitted that form, you absolutely should do that as soon as possible. Reason being, the longer that the Department of Education has to go back in time to verify not only your employment, but your payment history, right? The longer it's going to take them to review that form. And we're talking months, okay? And the more likely that they may make a mistake. So, it's highly encouraged that you submit the employment certification form early and often. Okay, there's no harm in submitting it even every couple of months. I have borrowers who are nearing that 120 and so are submitting that thing every 3 months until they see that number hit 120. Okay, so we'll basically certify those qualifying credits up to the time the form was signed. All right. We have a lot of important policy updates to get through. I'm going to take a quick peek at the Q&A. I know Dylan is doing her best to work through these. We've gotten a ton of questions coming through. Oh man, she's already answered about 35 of them, just to give you a sense. So I'm going to keep chugging along here just in the interest of time. And Dylan is going to do her best, and hopefully we will get some time after these policy updates to check back in on the Q&A. But this is some really important information that we want to share with you as of today, March 18th. All right, so let's talk about the SAVE plan. So in the last couple of weeks, there's been a little bit of news about the SAVE plan. Okay, it's almost came back to life a little bit until on March 9th. All right, the Eighth Circuit Court of Appeals ruled that the SAVE plan must be permanently ended. Okay, and this court's decision basically ordered the lower district court to finalize a settlement between the Department of Education and the state of Missouri to shut that program down. Okay, this had been in the works for a long time, and this is why uh, many or borrowers on Save were put onto a forbearance, okay, over a year and a half ago, when there was an injunction in the courts that basically prevented the plan from moving forward. And so as a result, those borrowers were pretty much put into a suspension of time in which they didn't have to make payments on the plan, and they remain there to this day. So this settlement requires the Department of Education to stop enrolling borrowers in SAVE, which that hasn't happened in over a year and a half, to reject any pending SAVE applications, end loan forgiveness under SAVE, so that would be income-driven repayment forgiveness, and then most importantly, move any current borrowers in SAVE into other repayment plans. Now, this is the most important impact. There are currently more than 7 million borrowers still enrolled in SAVE and on this administrative forbearance, okay? And they will need to transition to another repayment plan sooner rather than later. So, what does that mean for you if you are one of these borrowers? What happens next? So, borrowers currently in SAVE, as I mentioned, remain in this administrative forbearance for now while the Department of Education issues guidance on how this transition will work. They have not said anything yet. The Department of Ed says instructions for switching plans will be released in the coming weeks, and you can be sure that we are monitoring the situation and will communicate with all Savvy borrowers. So if you have a Savvy account, you get our policy updates when this guidance is released. But borrowers will likely need to move to another income-driven repayment plan, is the long and short of it. And your repayment options include any of the three existing income-driven repayment plans, right? Pay, IBR, and ICR, or a new repayment plan called the Repayment Assistance Plan, or RAP. This is a new income-driven repayment plan being introduced by the administration. It is not yet available. It is scheduled to be released July 1 of this year. Okay, so in sort of the immediate term, the only options on the income-driven repayment side are those three existing IDR plans. The key takeaway here for SAVE borrowers is SAVE is being permanently phased out. Okay. And borrowers have been on forbearance for quite a while, right, where they have not had to make payments. You don't need to take action just yet, okay? I would say we are advising borrowers to wait until the Department of Education releases that transition guidance, and that will make clear exactly what will have to happen next. And of course, Savvy's going to be here to help assist anyone in making that transition. Okay, now we talked about income-driven repayment plans that are still available, right? But really, timing is of the essence here. Borrowers can still enroll in IBR, Pay, or ICR, or they can switch out of Save into those plans or switch from IBR to Pay, whatever they'd like, all right? A couple things we want to just make sure you're aware of. Recently, the rules for eligibility around IBR specifically were expanded so that more borrowers are actually able to qualify than before. You no longer need to prove a partial financial hardship to qualify for IBR, which means the plan is open to more people. And generally, IBR may be a lower monthly payment than the plan you were on before. So again, the Savvy tool is great for this because it's going to show you which plan, regardless, is going to be the lowest monthly payment amount possible. Okay. However, we want to make sure everyone is aware that there are still severe processing delays going on at the Department of Education. And this stemmed all the way from the beginning of 2025, when for several months, the Department of Ed basically paused all processing on all applications coming in. They actually took down the online application from federal student aid. And that resulted in a massive backlog. We're talking millions plus of applications that were being submitted and just sitting there and not being processed. As of today, hundreds of thousands of applications are still sitting in backlog, and forgiveness approvals are moving very slowly, especially for something called the PSLF buyback request, which we're not going to touch on in detail too much today, but we have a Help Center article that is a great outline of exactly what that is, and if you are eligible at this time. But all to say that these delays remain real. So, if you have submitted an application and haven't heard anything, or you're thinking about submitting an application, the sooner the better, right? But be aware that it could take longer, okay, than you would expect it to. All right. But again, because these delays and backlogs are taking forever to sort of dwindle down. Now, while all of that is happening, the Department of Education and the Trump administration are essentially trying to rebuild the repayment system, okay, in real time. What do I mean by this? Well, over the next few years, okay, as a result of the One Big Beautiful Bill Act that was signed into law last year, under that act, the menu of available repayment options, specifically income-driven repayment plans, is scheduled to shrink. Okay. The pay and ICR plans are going to be phased out by 2028. All right. And like I mentioned before, a new IDR plan called the Repayment Assistance Plan, or RAP, is scheduled to launch July 1 of this year. Now, RAP is designed to prevent balances from ballooning by waiving unpaid interest for borrowers who make their required monthly payment. All right, so similar to the SAVE plan. It also includes a small monthly principal benefit for some borrowers. That said, RAP's forgiveness timeline, okay, under IDR forgiveness, is longer than what many borrowers associate with IDR today. It's not 20 to 25 years, it's extended to 30 years, okay? So the big point here being the repayment system that you started with, okay, when you entered repayment, is not going to be the one you will likely finish with. So it's worth understanding the direction these policies are going. And don't worry, that's not up to you. That's on us. And we will communicate with all of you, right, as these changes are coming through. And the Savvy tool and your account will always reflect the latest policy updates and availability of these plans. So you'd be able to see at any point in time, based on what is actually available by law, what plans you'd be eligible for. All right, transitioning a little bit, I want to talk about collections for borrowers in default, specifically wage garnishment. So if you go into default on your student loans, okay, and that is 9 or more consecutive months of missed payments, okay, that results in going into default, all right, you become subject to what are called involuntary collections. So as opposed to any other private debt, okay, when it comes to a federal debt, the government doesn't let that go. They will come after you until it is repaid. And that's what these involuntary collections are for. So, wage garnishment is a type of involuntary collection that borrowers in default can be subject to. And it basically takes 15% of every paycheck or your disposable pay, all right, that is withheld, okay, by the Department of Education. They send a letter to your employer that the employer is legally bound to process that garnishment, okay? And once that starts, all right, once that garnishment goes into place, it is very difficult and it takes a long time, upwards of 9 or more months, okay, for it to be removed. That's a long time of losing 15% of every single paycheck, and you have no control over that. So garnishments can start very quickly, right? If you hit that default, you are now subject to a wage garnishment. And again, it's going to pull money right from that paycheck without a court order. It's doing it through your employer because that employer is legally bound to. And the only way to reverse it is to rehabilitate your loan and bring that defaulted loan back into good standing. And that process takes 9 months, during which you will continue to be garnished. So, when it comes to these wage garnishments, okay, in this collections, the Department of Education announced at the beginning of the year, January 1, that they were going to be resuming these garnishments early in January. All right. And then a few weeks later, they issued a statement saying they were going to put wage garnishment on a temporary hold. Okay. Following other recent federal guidance. So enforcement of wage garnishment has been paused until further notice. However, this pause should not be taken as sort of a get out of jail free card. It's a chance for anyone who may have been in default to do whatever they can to rehabilitate that loan, all right, and get that loan back into good standing. And if you are one of those borrowers who knows they're in default, or even if you are concerned you might be or you're not sure. That the not sure category is probably the most important one here because so many borrowers just aren't sure. Now is the time to address that situation and work with Savvy to figure out what status your loans are in, so that we can intervene before things reach the point of wage garnishment. Because it will resume, all right, whether it's next month or later this spring or summer. Wage garnishment will resume, and so anyone in default will want to make sure they have taken steps to try to bring that loan back into good standing. Speaking of default, more and more borrowers are falling behind every day. I'll tell you a statistic that will probably blow your mind, but every 9 seconds, a student loan borrower falls into default. Okay. Currently, there are 9 million people out of 42 plus Americans with student loans. 9 million are in default. That is one in every five student loan borrowers. It is the highest number on record in history of federal student loans. Okay. I'll tell you something else. One in four borrowers, all right, so 25% are delinquent. Delinquent means you've missed three or more payments in a row. Okay. And the sort of the slope is very slippery from delinquency into default. Okay. And more borrowers are seeming to enter that pipeline where a few missed payments turns into three, which turns into delinquency. And then before they know it, those loans have been pushed into default. And many borrowers are sort of teetering on that edge. And I will tell you, the impacts are not just around your student loans. When you get reported by the credit bureaus as delinquent, okay, we are seeing average credit scores drop by 57 to 100 points overnight, okay, just based on that reporting of delinquency to the credit bureaus. Okay, keep in mind those federal loans are now being reported, right? So on-time payments, missed payments, delinquency status is is sort of the second most severe to default, all right? Now, I want to be clear about something. This is not on the borrowers. The system itself is making it harder, not easier. Repayment options keep changing. I mean, point in case what we've talked about here today. Servicers are hard to reach. I'm sure half of you, if not more, have tried to reach out to your servicer, maybe unsuccessfully, whether you've had to wait on hold for hours or more, who knows, right? Or been given wrong or misleading information, okay, and you're not sure who to trust. And the cost of living is growing increasingly higher, it seems, every day. And this is just putting more and more borrowers at a higher risk this year. All right. So this is something that is very serious because the consequences are punitive and they can impact your broader financial life, not just your student loans, right? A credit score drop like that can ruin your chances of being able to get an auto loan or a mortgage or things like that. All right. And it's very difficult to recover from that on the credit score front. So, again, I'll make this point to all of you. If you are anywhere in the category of not sure to I know I'm in default, please make sure you sign up for your Savvy account, have access to that, and reach out to our support team so we can intervene and help you on your behalf and get you back on track. If you know exactly where you stand on your student loans and you know you've been making payments and you're in good standing, okay, fine. Everyone else who's maybe not sure at the slightest bit, right? You would hate yourself if you let that little bit of doubt remain, only to find out months from now you were in default and now things are really, really bad and serious. So we want people to take this seriously, again, because these consequences are so serious. But the good news is that we exist to be able to help you navigate out of that. Okay, that's why we are here. All right, let's talk about Parent Plus loan borrowers. Okay, and I hinted at this a little bit earlier in the presentation, but for Parent Plus loans, the rules are changing completely in 2026. Basically, Parent Plus loan borrowers are going to have fewer repayment and forgiveness options going forward, and the timing of all this will matter more than ever. Now, consolidation, right? We've said that word a couple times before. If you have Parent Plus loans, consolidation is required in order to keep your options open when it comes to things like income-driven repayment or public service loan forgiveness. Borrowers with Parent Plus loans who do not have or who have not completed a consolidation on those loans by July 1 of this year will lose access to income-driven repayment and therefore will lose access to both IDR forgiveness and public service loan forgiveness. This is a very firm deadline. And it is not submitting the consolidation application by July 1. That loan must be fully consolidated. That must be complete by July 1. Okay. Now, consolidation applications take anywhere between 6 to 8 weeks at best to process and complete. All right. After being submitted. Now, imagine we already talked about the processing backlogs and application delays right at the Department of Ed. Well, we now have a scenario where there's a major deadline coming up, and we're going to have hundreds of thousands of Parent Plus loan borrowers all submitting consolidation applications at the same time, which is likely going to delay that timeline even further, okay, and could take upwards of 2 months or more for a consolidation to complete. And again, that consolidation has to be complete at the end of the day by July 1. So we are recommending, and so is the Department of Education, that any and all Parent Plus loan borrowers submit their consolidation application by April 1, the end of this month, basically, to allow proper time for processing. I can't emphasize enough, missing this deadline will have very drastic consequences. As a Parent Plus loan borrower, your only option for repayment on those loans, if you do not consolidate by July 1 or it's not completed by July 1, will be the standard plan. Okay, you will not be eligible for any the new RAP plan either. It will be the standard plan amount, which will be based on how much student debt you have, which will likely be or could be a much higher monthly payment amount. And you will have no alternative options and no income-driven repayment options available. So this is probably one of the most serious and consequential deadlines that any borrowers have experienced in the last couple of years at least. And we want to make sure that everyone who has Parent Plus loans is aware of this. Now, again, to be clear, this isn't about fear. It's about clarity, right? These new rules that are coming into place are quietly narrowing, right, eligibility under certain plans and things like that. And Parent Plus loan borrowers, unfortunately, have always gotten the short end of the stick, it seems, but they are among the most affected. So again, if you are not sure if you've consolidated your Parent Plus loan, maybe you think you have, maybe you need to, right? Wherever you may fall on that sort of time on that sort of line of Parent Plus loan borrowers, with your Savvy account, when those loans are synced, we are going to be able to automatically detect the status of that Parent Plus loan, and whether or not it's been consolidated. And if it hasn't, we will assist you with that process from there. So we have about until the end of this month, really, to be safe, in order to complete those consolidations. All right. Last thing I want to talk about here on the policy front is public service loan forgiveness. Some of you may have been hearing about PSLF in the news at the end of last year. So I want to make just sort of a few things clear when it comes to PSLF. So PSLF is still in place, as we talked about earlier in the presentation, and protected by law. In fact, and I love saying this, it remains one of the strongest safeguards in the federal student loan system. Why? Because it was written into law. This was why PSLF, okay, now compared to the SAVE plan, right? The SAVE plan was not written into law, and that's why it was was able to easily be challenged, right, in the courts and overturned. Compared to PSLF, that is law, okay, passed by Congress. However, okay, despite that, the experience, right, of trying to pursue PSLF or IDR forgiveness has become more uncertain, whether it's the processing delays, employer verification issues, certain policy changes, right? It's made PSLF feel harder to navigate, okay? So if you've been feeling that way, you're not alone and you're absolutely right. There's also something else sort of going on with PSLF. It's kind of been sort of taking a back seat, but it's going to take effect July 1 of this year as well. And it involves new employer eligibility rules. Basically, the Department of Education has finalized rules that would allow the Secretary of Education to deny PSLF to certain employers that it deems to be engaged in illegal activity. Okay. Now, it has a couple of different definitions as to what constitutes illegal activity, but this is not about the borrower. Okay, it's about the employer eligibility. And so these new rules essentially say the Department of Education can take away an employer's eligibility for the program. Uh, and they estimate that less than 10 employers nationwide would be impacted by this. Okay. So, just to give you a sense, there are a little over 2.5 million nonprofit employers, and probably double that on the government side. So, it's a relatively small amount. Most of you, if not all, will be not impacted by this at all. Um, but still, the change adds uncertainty, all right, and underscores sort of the political aspect of some of these things. And more importantly, why keeping documentation, okay, via that employment certification form and submitting those forms regularly, especially if you've never submitted them before, matters more than ever now, okay? If there is an employer, let's say it happens to be one of your employers, that loses eligibility for the program, okay, starting July 1, all of your qualifying employment up to that point will remain and it will count towards PSLF. It will only be going forward that that employment will no longer be eligible to count as qualifying for the program. Okay. So we have not yet heard any more news as to what employers they will have identified. There are currently actually, I believe it's 20 plus state attorney generals and DC that have filed a lawsuit against the Department of Education around this because they deem it sort of illegal. The rules of the program written into law never specified any sort of leniency or flexibility when it comes to the Secretary of Education being able to determine eligibility or not, right? Eligibility is clear by the law. it's a government organization, and it's a nonprofit 501(c)(3). If an employer is one of those statuses, it is eligible, and that is it. So we are monitoring this as well, and we'll keep you all posted. All right. Again, we send out those policy updates, our state of student debt. If anything breaks that you need to know about, you will hear it first from us. All right. I know we are running up to time here. Let's see. Up, yeah, we're a little bit about a minute over. So I am going to take a quick peek at the Q&A and see if there's anything I can quickly fire off in response. We Dylan had to hop, so I've lost my Q&A teammate here. But okay, well, I saw my pulse check is I hate all of this. That's a very fair pulse check, and I'm sure probably most of the people on here today agree with you, including myself. And I have to deliver this news every day. Unfortunately, I know how firsthand how much this stinks, and it has for a very, very long time. And people who don't have student loans don't really understand what it is like to have student loans in this day and age. If you think about if this was happening with, the credit card industry, right, there would be a massive outrage. It's impossible for people to wrap their minds around. But that said, that's why we host these webinars, and that's also why Savvy exists, so that you can get the one-on-one help to make sure that you're doing what you need to, and that you're going to reach that finish line. All right, so let me see if a couple questions I can answer out loud. Okay. All right. I'm seeing some questions about forbearance and qualifying for PSLF. All right. So let me make a quick statement here on this. Um, when it comes to forbearance, okay, when you haven't been making a payment, let's talk about two different types of forbearances recently where borrowers were put into those forbearances automatically. The first, the COVID pandemic payment pause, right? March of 2020 through October 2023, okay, where majority of federal student loan borrowers were had their payments paused and interest waived, right? I believe it's about 43 months total that those payments were paused. That administrative forbearance period, if you were working for a qualifying public service employer, those months of no payment count as qualifying credits, okay? That counts. That's 43 credits towards the 120, right? That's putting you over a third of the way closer to forgiveness. That period does count. However, if you enrolled in the SAVE plan, okay, then in, let's see, July of 2024, you were placed into an automatic administrative forbearance when a court injunction went into place, okay, and they could no longer process the plan. And unless you've switched out of it, you've been on that SAVE forbearance since. That forbearance does not count towards PSLF as qualifying payment credits. I know that that is not fair. You didn't choose to go into that forbearance, but that's how it's been decided. Now, there are a couple different options, okay, if you've been working for a qualifying employer as to how you deal with this. The first is if you want to start resuming making qualifying payments, you can switch into another income-driven repayment plan right now. You're going to have to switch eventually, right? Whatever the Department of Ed guidance may be, but you could go through it using Savvy. We could get you into the next most affordable income-driven repayment plan, and next month's payment that you make will count and qualify towards PSLF, okay? Now, what about the months since July 2024, right? That's, it's going to be coming up on 2 years worth of payments that don't count when you've been working for a qualifying employer. Well, you will have a mechanism of being able to request those months to count, and that is called PSLF buyback. This is what I mentioned earlier, right? PSLF buyback is essentially a program that or not a program, I should say, but something that they implemented at the Department of Education, whereby borrowers could request to buy back, okay, literally buying back months that they were put into forbearance. So it could be the SAVE forbearance period. It could be a forbearance period that you had 10 years ago, okay, that you yourself put yourself on, to buy back those months so they can count towards PSLF. And by buying them back, you basically would be paying for each month what you would have paid on the income-driven repayment plan at the time. So let's say I've been on, the Save forbearance, right? And under the Save plan, I qualified for a $10 payment a month. And I need to buy back 3 months of that forbearance time to reach the 120. I would pay $30 total, $10 for each month, right? And they will quote you a lump sum based on how much period of time you're trying to buy back. Now, the PSLF buyback request process, number one, is only open to borrowers who have on their Department of Education account certified 120 months of qualifying employment. Okay, that's not qualifying payments, that's qualifying employment. You won't even be able to submit a request unless you have at least 120 months or more of qualifying employment certified. So if you're thinking, how do I get 120 months? I know I've worked that much. You will just need to make sure you've submitted all your employment certification forms through current and present day to bring that current. So you can't even submit this until you've reached that 10-year mark, at least as far as time served. Okay. So that's number one most important on that. The second thing is the backlog for PSLF buyback is the longest of any application right now. I will be honest with you, it is upwards of a year or more waiting to hear back. Borrowers who submitted their applications around last January have still not heard back on their PSLF buyback request. So that being said, and again, you have to be at 120 years of qualifying employment to be able to submit it in the first place, right? So borrowers have a sort of decision to make. Many have made the decision to, you know what? I'm not going to wait on this PSLF buyback. This could come, it could never come. I'm anxious to get to that finish line. I'm just going to switch out of the save plan now, make the remaining payments I have to, and call it a day and get my forgiveness. Okay. Some have said, you know what, I'm just going to wait. I can't afford to make those other payments right now, and I don't want to switch. And so they're still waiting for that to process. But the PSLF buyback is a very slow moving thing. So keep that in mind with any type of strategy that you or decision you make when it comes to how you get to that 120. And if you have any questions or you need guidance or advice on what you should do, especially again, anyone who's pursuing PSLF right at the moment and who's in SAVE, please reach out to our borrower support team. Okay. And you can do that through your Savvy account. All right. Let's see. Okay. So someone says, so if you're not close to 120 payments, stay put. I mean, listen, you're going to have to move eventually, right, into another IDR plan. It's nice not having to make a payment on forbearance. I'm right there with you. So yes, I mean, you can absolutely stay put. There's nothing else you really can do besides move into another plan. If you do move into another plan, you will be able to obviously start making payments that qualify. But again, compared to the SAVE plan, right? The SAVE plan was the most affordable repayment plan in history to date. Like, a full stop. It basically cut payments in half for most borrowers. So any other income-driven repayment plan is going to be higher in comparison. Okay. Just across the board. All right. And that's, just the reality of the situation, unfortunately. So that factors in to many people's decisions on whether to stay put or not, right? But you will have to move eventually. How soon you will have to move, again, we're waiting on that guidance from the Department of Education. Okay, let's see here. So yeah, so if you were on the forbearance, or if you were on forbearance without the SAVE plan, how do you go about getting those months, for the 120? Is that the buyback? Yes, that's the buyback. Okay. But again, you won't even see that option available to you in your Department of Education account to request the buyback until you have that employment certified. And again, that employment certification takes time, right? A couple of months to review. So this is all why it's so important to submit those forms, especially now. I mean, I'm telling borrowers, if you're close to that 120 every 3 months, every six, let's get that employment certified because as soon as you reach the 120, you can submit that request. Okay. And with your Savvy account, you can submit employment certification forms as many times as you need to throughout the year. Okay, let's see here. Um, if there are any other questions, I want to make sure I show everyone how they can at least get started with their Savvy account. You know what? Let me keep chugging along. This is just the part where I want to make sure everyone can access the tools and their account so that, if you have to hop off or leave, you at least have a way of getting the help that you need going forward. And then I will hang around for as long as I can and try to answer any remaining questions that are here. We've gotten over 250 coming through, just to give you a sense of how many questions. So I'm only one person, but we'll try my best. Again, the best, if you have to hop off or if you don't get your question answered, uh, go through your Savvy account, click contact support. You can send a message to our team. This is our internal student loan expert team. Dylan is on there. These are amazing, incredible experts who are there to help you answer and navigate any of the questions that you might have. So that's where that question should be routed, so that you can get the help you need. Now, to the person who so eloquently, I'm still chuckling at the pulse check, said the pulse check was, I hate this. We all understand. We all feel the same way. I know that that was a lot of information to consume in one sitting. Oops. And it's constantly changing, unfortunately, right? That's the problem. Let me see if I can go back a slide here. So it's really very difficult to expect anyone, okay, rocket scientists, two PhDs or not, to be able to successfully navigate something that seems to be moving in real time underneath their feet. You're faced with a ton of different options, multiple repayment plans. Some are ending, some are coming back, some have deadlines, right? Some you need to consolidate. And so, it's natural if many of you are still left wondering, what is the best thing for me to do, right? And that's where we come in. Our goal is to make the best path clear. All right. So when you go through your Savvy account and set that up, we are going to ask you some basic questions, okay, around your income, your family size, your tax filing status, your employment, right? We'll sync your loans. All of this is to help us identify the optimal repayment and forgiveness plan, okay, for you, based on your personal information, right? So you don't need to know if you're eligible for IBR. We're going to tell you that, right? Based on your loans and everything else. We monitor for the new programs and policy changes. That is my explicit role here at Savvy since day one. And so you can count on the fact that what you're seeing on your Savvy account is reflective of the current date and time and second that you're seeing it. Okay. Now, I cannot say that for the Department of Education website, which I mean, it's been like this for years, but I'm constantly seeing articles or explanations or pages or links that have not been updated in months with the correct information, right? And are therefore indicating to borrowers something that may not be in their best interest, right? The Savvy tool is different. It's our job to make sure that we are ahead of the Department of Education's tool. And so that's why we're able to get borrowers enrolled in these things successfully and quickly and help them reach that outcome or the best outcome possible. And then we take it a step further. We've got applications, employment certification forms, right? We've got income-driven repayment applications. All of these are administrative burdens on you, the borrower. And while it might just seem like a form, paperwork, and application, unfortunately, it has meant the difference between the majority of borrowers succeeding in these programs and not. Public service loan forgiveness had a 99% rejection rate up until a few years ago. Why? Mostly because of clerical and administrative errors on these forms. Okay. Borrowers submitting them incorrectly or the employer not filling it out correctly, right? And then a couple months go by, and that's when the borrower will find out it's been rejected, and they're not sure why, and they think maybe they're just not eligible, when in fact it was because their employer filled out the format of the date wrong. And I kid you not, that is exactly why they will reject an application. That's where we come in. We pre-fill and digitize all of the forms that you will need to submit, and we submit them on your behalf. So when we submit a form, okay, from on your behalf through Savvy, we know it should be accepted because we remove all of the human error and how we set those up. And so we know that we're right. And we know that if there are any issues that come back, right, that it's actually on the error of the servicer or the Department of Education, which happens more often than not. Okay. So we take care of all of that for you, monitor the progress of that application, right, each and every step of the way to ensure that it reaches its desired outcome and achieves that desired outcome. And then the best part of all is that at any point in time, let's say it's a month into submitting it, right? And you're wondering, you haven't heard anything from the Department of Education. Who do you reach out? Well, what is everything still on track? That's where you reach out to us here at Savvy. Hey, do I need to do anything? I haven't heard anything yet. Nope, you're all good, Lindsay. The Department of Education is still processing. Remember those backlogs. So let's give it another month. If you don't hear by then, we'll help you reach out. All right. We help to monitor that status to ensure that we're holding the servicers accountable, but making sure that you actually get to the finish line. And the best part is that we use the technology to make it easy. So instead of having to fill out all these different applications on your own, with Savvy, you fill out one application. We call it the Savvy application, okay, where you're entering all your information in, right? Your income stuff, your employment, you sync your loans, and then we identify the best options, okay, and you get to choose. And then we fill out the applications for you. So you're not having to print and manage things, fax forms on your own, figure out which is the right form. Again, we collect it all through your account and then are able to pre-fill and digitize and submit those on your behalf. So to get started with Savvy, you can scan this QR code to sign up, or if you want to just follow along with me quickly here as I run through a few quick sort of slides to give you a look and feel of how Savvy works, you will receive an email after the session, okay, with an activation link to get started with your account. All right, so you can just kind of follow along if you want to, or scan that QR code. Again, not to worry, all of this will be sort of sent to you, right, in that email following the session. FYI, it goes out about 24 hours after the session ends. Okay, so tomorrow evening. You can access your SEIU MB account. This is how you get the special discounted version of Savvy that is provided to SEIU members. You're going to want to go to seiumb.com/getnav. And I will try to write this in the chat right here. Oops, hold on. I'm a terrible typer. Okay. Let me post this so anyone can click on that link /getnav. Okay. I put that link in the chat. You will need to log in to your member benefits account. If you don't have one, make sure you set one up because this is how you're going to get access to Savvy and get that SEIU discount. You can click Get Started from there. And that will allow you to access the SEIU Savvy Student Loan Navigator, okay, that is designed around and specifically for SEIU members and their family members, all right? So this is the screen that you might see, all right? When it comes to your Savvy account, logging in at any point in time, right, you are brought to what's called your Savvy dashboard. And this is sort of like mission control for everything that you're going to be doing with your loans and in Savvy. And it's where you can do a lot of different things, see the status of your active applications and all that good stuff. Now, if you're starting the process for the first time, you're going to need to fill out your Savvy application, right? This is almost like filling out your, an account, right? Or think about this, just like TurboTax for your student loans. So again, we're going to ask you some questions about what state you live in. What is your current tax filing status, right? How many dependents do you have? We talked, earlier in the presentation about how those impact calculations on an income-driven repayment plan, right? We're going to ask you about your income, okay? Again, for income-driven repayment purposes. And then your employment. This one is very important for anyone who is trying to determine their qualifications for forgiveness programs like public service loan forgiveness. We have a database built into the tool of every single public service loan forgiveness eligible employer in the country. So if you start typing in your employer name, it should pop up from the drop-down menu. We'll ask you some further qualifying questions or clarifying questions, right? To help us understand what that eligibility looked like at that employer. And then we encourage you to add not just your current employer, but any previous employment you might have had, right? Because these programs are retroactive. So by adding previous qualifying employers, you're helping us to understand the full extent of what your eligibility looks like and where and how much progress you've made towards that 120. We also are able to detect based on employer, any qualifying borrowers for teacher loan forgiveness. We didn't talk about that program here today. Teacher loan forgiveness is a program for educators working in Title I schools. So we have that built in as well, and it will be able to detect based on the name of the school that you are entering in or school district. And then the last step in the process is linking your federal and or private student loans. And you've got a couple of different options to do this. You can either use our loan sync, which is pretty quick and easy. You enter your phone number, date of birth. It's going to pull over the loan information, just a read only, right? So we can verify what those loans, the disbursement date, interest rate, all that stuff looks like. Okay. You can upload what's called your student loan data file. This is something we provide you with the instructions on how to download from your Department of Education account. All right. Or you can enter the information in manually, which I find to be the most tedious only because most borrowers have on average between 5 to 6 different student loans, right? They were dispersed over different periods, all with different disbursement dates, interest rates, balances, etc. So it's a lot to sort of know off the top of your head. So we want to make sure that information is accurate, and that's why we allow for a couple different ways to upload or link. And then that's it. You reach the end here, what we call our plan options page. And this is where we show you what your best options would be, all right, when it comes to repayment and if you're eligible, forgiveness. So you can see here, and at the top, we're going to identify what we think is the best one, okay? You can see this is someone who's eligible for the pay plan, all right? So they see what their new monthly payment would be, all right? What that total payment over time looks like, so how much they will have paid in total by the time they reach that forgiveness, how long until they'd reach forgiveness, and exactly how much in forgiveness they would achieve, okay, or receive, I should say. They can expand below where it says show plan details to see a comparison of pay, okay, the pay plan to other plans, specifically like the standard plan, all right, things like that. You may be eligible for IBR and ICR too, so you'll be able to see those as well and what those monthly payments look like. But again, we put the one at the top as the one we've identified generally as the one to have that lowest monthly payment and be the best when it comes to optimizing your forgiveness. Now, it's at this point where the next steps are going to be submitting applications, right? Enrolling on the pay plan. Okay, that's that IDR application. And how do we get progress towards public service loan forgiveness? That's the employment certification forms, right? So you have some options. You can either choose to remain on our DIY plan, which is completely free, okay? And we will provide you with those applications and forms, all right, and the instructions on how to submit them yourself, okay? Again, completely free. So it's completely free to start and set up your Savvy account, enter all your information, sync your loans, see your best options, and we send you the applications that you need to submit. All right. And you can attend webinars, etc., access our help center, all of that good stuff. You'll receive all of our policy updates and emails. However, we provide the option for borrowers who want us to take on that administrative burden, right? They can upgrade to what we call the essential plan. This is at $55 a year. Okay, that is reduced from $90 for SEIU members. I will tell you, SEIU being the long and loyal partner of Savvy that it has been since our inception as a company, this is the lowest rate of any partner that we have, and we continue to provide that because we are huge union supporters. So that is $55 a year, and that includes all the application support, income-driven repayment, public service loan forgiveness. If you need to submit 10 employment certification forms, it's all covered under there. And most of all, it includes one-on-one personalized support and access to our student loan experts. So Dylan, who might have been answering your questions here today, she may be the student loan expert that gets assigned to you. You work with the same person throughout the entire process that you are working with Savvy. So you're not having to repeat yourself, feel like you're being tossed around, getting different information. We felt that that was an important part of the human support aspect here. You get all the annual enrollment reminders and policy updates, the ongoing plan monitoring and management, right? We've introduced some features that help borrowers avoid delinquency and default based on their loan sync. We're able to detect if a payment was recently made, and if it wasn't, we reach out to those borrowers. But really, this helps make sure that we're maximizing your forgiveness credits. So many borrowers could be at the finish line for programs like PSLF if they knew what was either going on or were taking the right steps, submitting the proper forms to do so. And that's no fault of their own. I think we all agree, right, how impossible this system is. So that's why we exist. This isn't something that, we wish we didn't need to exist, right? But unfortunately, this is the reality. And so we saw a need. It's 100% money back guarantee, by the way. So if you upgrade and you feel you are not getting the value, you can request a refund, no questions asked. We also provide a pro plan. This is sort of like our the highest level concierge tier of support. I would say for those that are maybe a little bit less technologically savvy, no pun intended, but are really looking to have someone help them set up their Savvy account, want to have a conversation and walk them through what they need to, what's going on, and just really have more of a handheld experience. The pro plan might be for you. With the pro plan, it's everything that's an essential, but you are able to schedule a personalized onboarding session from your Savvy account. You can pick the time and date on the calendar, and one of our student loan experts will call you and walk you through everything that you need to know. You get dedicated Savvy phone support, and a comprehensive student loan review with that. And so that's at $140 a year, which is discounted for SEIU members from $200. But really essential is the one that's going to cover everything that you'd need to do. But again, many borrowers will opt for Pro because and I totally understand it, really just want to be walked through it and feel like they can have sort of a sit down and understand what's going on and get on the same page before they move forward. So it's up to you. Now, if you do decide to enroll in Essential or Pro, once we have now pre-filled those applications, you're able to so easily monitor them from your Savvy account whenever you log in. So you can see here on the left, this is someone with 3 employment certification forms, right? That are in progress, different points in their sort of journey, and their income-driven repayment application, right? And then on the right here is sort of just an example of what that kind of monitoring looks like, zoomed in, right? What we've submitted on their behalf, what we might still need from you, the borrower, the estimated review times from the Department of Education, right? This provides a level of transparency and visibility into the process that I don't think exists anywhere else. It doesn't exist with your servicer. I know that firsthand because I log into my servicer account all the time, and it's very unclear what's happening. Or if I've submitted an application, what the status of that application is, right? There's no confirmation they send me that they've received it. I'm just left wondering, right? And that peace of mind, and also knowing that someone is sort of helping monitor that for you so that you don't have to, is everything when it comes to student loans. And then last but not least, the customer support, right? So when and if you do need help, have a question, want to just, make sure everything's okay, right? I would say our most common sort of, request that we get from people through, that contact support, right, is just a message like, I just want to make sure I've done everything I need to, and everything's okay with my situation, right? And we get that probably 75% of the time, and that's exactly why we're here. Yep, we look into it, everything is good. We're waiting on the Department of Education to finish its review. We check back in a couple weeks, right? You can access a lot of the content that I talked about here tonight through our help center. I suggest that looking at the article on PSLF buyback, if you are interested. But again, if and when you ever need, as many times as you need, through your Savvy account, you can send us a message that goes right to your dedicated expert. You can also live chat. We might not have our agents on live chat right now. It's not AI. It's actually Dylan and her team in real time, talking back and forth over the account chat. And we have a telephone number as well that is accessible, to Essential and Pro members. And that has a wait time of 2.5 seconds. It might be less than that, actually. But compare that to what your average wait time is at your servicer. We just don't put the telephone number up here publicly because it always gets inundated, and we want to make sure that's reserved for those who have that Essential or Pro plan. But again, if you have any questions, you can reach out to our support team if you need their help. Okay, so I know we are over time here. So just to sort of wrap things up and put a few final touches on this, and then I promise I'll try to get to a few of these questions in the Q&A for those of you who are still sticking around. What's next? Want to make sure that you have access to your Savvy account, whether that's creating it for the first time, again, logging in through your SEIUMB portal. Let me just make sure I got that one right. I'm going to repost this in the chat. It is SEIUMB /get nav. Okay. You're going to want to log in through there. That's how you're going to get to the specific SEIU member page with those discounted rates. All right. Oh, and I can't believe I forgot to say this for those of you who are still on. Let me backtrack. Well, let me hold on. From your Savvy dashboard. Okay. Oops. Let's see here. I'm going to give you a way to get a 50% off coupon code. All right, let's see. Sorry, guys. Okay. Oops. So from your Savvy dashboard, right? See where it says invite friends and family? If you click that and you enter the email address of 3 friends or family, okay, and you click invite, you will get a 50% off coupon code to use towards Essential immediately in your inbox. Okay. So that brings, it's not, unfortunately, it's not applicable towards Pro, but it is applicable towards Essential. All right, so that brings that down to $27.50 for the year. All right, and the people you invite don't need to do anything, right? Most referrals, you need to invite someone, then they need to purchase something. That's not how it works with this. You simply need to put in their email addresses of anyone who you know is student loan debt or 3 friends and family, right? They will receive a link to create a free Savvy account, but you will automatically receive a 50% off coupon code to use towards Essential. And I think $27 for an entire year's worth of student loan support in this landscape is pretty incredible. So just want to make sure everyone is aware of that. Now back to what's next. Again, making sure you have access to your Savvy account. Everyone's going to receive an email following the session, right, with any links to set that up. And fill out your Savvy application. See what's going on. See what your options are. Sync your loans. I would say if you are in the category of, I know I'm in default, I know I'm behind, I'm looking at my servicer account, I'm past due, it's showing me past due, right? Or I'm not really sure what's going on. Please take my advice seriously. Now would be the time to reach out and let us help you figure this out, right? Like, let us help correct the situation sooner rather than later. Because my biggest concern this year is the growing delinquency and default. And I can't tell you, it really dawns on most borrowers when they all of a sudden go to apply for a credit card and get denied. And they see that their credit score has dropped 150 points into subprime territory overnight because of their student loans, all right, after having missed just a few payments. So we want to get that back on track. And that's why we're here. All right. Okay, let's see. Oh, we are really over time here. Okay. Let's see. I'm going to start from the bottom of the Q&A. So if you are still on and you asked a question and would really like me to answer it, if you wouldn't mind, because I know at this point probably half of you have left, and I'm not gonna bother answering someone's question out loud who may have left. That's okay. If you wouldn't mind reposting it in the Q&A, just copy and paste. I will make sure to answer that. Okay. All right, Keegan, I got you. So I was showing 119 qualifying payments, and then it's all changed since the forced forbearance has been lifted. It reflects zero of 120 payments now. What do I do? Okay. So I'm not sure what exactly uh, you mean by the forced forbearance has been lifted, if that was referring to the COVID pandemic forbearance, um, or the SAVE, because the SAVE forbearance is still in effect. But all to say, this sounds like something where I'm going to want our support team to be looking at your account with you, right? Or for you to be able to show them what you're seeing. It's hard for me to be able to give you that advice just based on the limited information I'm seeing here. One of the reasons you that I sort of frequently will see someone whose credits have a significant change is, well, first of all, if you have multiple loans, okay, there could be some loans that are at different credit points than others, right? Because you've been in repayment on some of the loans longer than others. So they are closer to that 120 than the other loans are, right? Now, if usually if a loan reflects zero out of 120 payments, or if a balance on a loan reflects $0, it's the result of a consolidation. Okay. It basically will say, balance paid in full. All right. And it'll show $0. And that's because the loan was consolidated. If you don't think you've consolidated or taken that action, then we definitely want to look into exactly what's happening. So I would highly suggest please reaching out to our support team if you haven't upgraded to Essential, but they can take a look at your loans and then hop on the phone with you and look at your student aid account and figure out what exactly is going on. All right. Okay. Let's see here. Okay. Yes, the COVID. All right. So, uh, let's see. I mean, again, it might be a different loan, but if you were at 119, the credit should never have disappeared. So perhaps there is some type of error or issue, and again, that's why I'm going to want our team to look at it, right? Because that doesn't sound correct at all. The only thing I can think of is if there's multiple loans here at play with different sort of credits, qualifying credit counts. Okay. Um, Okay, let's see. Someone asked, how can I receive the recording of the meeting? You're going to get it via email 24 hours from now. All right. And we will likely post it on YouTube as well, but everyone will receive it in their inbox. Okay. Carla, if I am married and we both have student loans, do I need to fill out a separate application for him as well, or combine our information? So if he has his own student loans, you want to invite him so he can create his own account and enter his information and sync his loans. All right. So you'll both want to have separate Savvy accounts, but you will be asked as part of that sort of first screen of family information, right? One of the questions we asked is, if you are married, does your spouse have student loans? And I believe it actually gives you the option right there to enter their email address and they receive a link to create that account. Okay, so it'll help you to do that naturally. But yes, you're not going to want to combine that into one. Each of you should have your own separate account. Okay, Nicolene, I might have missed the answer, but should I make a Savvy account for my parent? Uh, has 85% of my loans in a Parent Plus in their name, or would making an account for myself include guidance on the soon-to-be consolidated loan? Okay, so if you're, managing the repayment of that Parent Plus loan, right? Or if you have your own separate loans, okay, I would say you should definitely keep them separate. If you have your own loans, Nicolene, and your parent has Parent Plus loans, don't combine them into one. All right. I was thinking maybe you just, had the loans, your Parent Plus loans for your parent, right? So you were trying to do it on their behalf. But all to say, always keeping them separate. You and anyone else in the family, you always want those separate accounts, okay? Um, and you will want to, have either your parent go through that process and setting it up and syncing, or uh, you if you want to help them and do that on their behalf, and they will then be able to sort of go through, enter the information, and that's when we will be able to detect or not, whether they likely need to consolidate, right, and help them take those next steps. So, I think you can just be an active supporter of your parent as far as getting them set up with that account, and making sure that they're checking their emails and filling that out, right? And sort of just checking in on them on their sort of communication channels, right? Checking their email, etc. And of course, if you want to reach out to Savvy through your own account on behalf of your dad and ask for that assistance, of course, we will make sure that we connect with him. But you want to keep those loans separate, yours and his Parent Plus loans. Okay, someone asked how much longer is this class? Everyone is totally free to drop. I am just remaining on to answer questions for those who have stuck around here with me. So please feel free to drop if you are good to go. Otherwise, I'm going to try to just run through the last few questions for those who have stuck around and have some. Okay, Ram, do we pay the interest for both IDR and PSLF loans? Okay, so IDR and PSLF loans. So those are two different. IDR is for repayment plans, right? PSLF is forgiveness. So they aren't types of loans. I'm trying to see if I can make sense of what exactly it is you're asking. Um, I think maybe you mean forgiveness. So do we pay the interest for both IDR forgiveness and PSLF forgiveness? The answer is you get everything forgiven under both. So I'm trying to think about what sometimes it's interpreting. So maybe what you mean is, are you making interest payments on an IDR if you are pursuing public service loan forgiveness? The answer is this. If you are setting yourself up for PSLF, right? Okay. That's the goal. You plan on continuing to work. You're either close or you're on your way. You plan on continuing to work in that capacity. And they're part of the, obviously the qualification, right? You need to be on an income-driven repayment plan. Your goal is to minimize your monthly payment as much as possible to maximize the forgiveness. There is no glory, honor, bonus points in paying more than the absolute minimum that's due. And in fact, we do everything we can to try to minimize the payments for the borrowers, right, who are heading towards PSLF. Why? Because all of it's going to be forgiven anyway, right? So you making an extra payment or paying, let's say your minimum payment is $50 and you say, I'll pay 75, right, to cover some of the more of the interest, you're just throwing money out the window. That would have been forgiven, right? So if you are setting yourself up for PSLF, I know it's sometimes sort of scary to see the interest accumulate and that balance, sort of rise, right? Trust me, I mean, mine's grown from probably about 170,000 to a little over 200,000 in interest alone, okay? And that's how the interest capitalization unfortunately works. But for PSLF borrowers, the great news is that that's okay, right? You don't have that shouldn't concern you. Your sole concern should be minimizing your monthly payment on the best possible IDR, right? And just making that monthly payment and sticking and making those payments. All right. No extra payments, no overpayments. Again, it is lighting money on fire that would have been forgiven. Okay, how do I consolidate my Parent Plus loan? So if you, in your Savvy account, right, when you sync those loans, as soon as you've synced them and you have Parent Plus loans, and it's going to identify for you right then and there that they need to be consolidated. And when you reach that plan options page, it actually won't let you proceed. It basically will sort of a screen will appear first that says, hey, first things first, you need to consolidate these, right? Because you're not even going to be able to enroll until you've consolidated. And it provides you with step-by-step video and written instructions and the link of how to do that on studentaid.gov. Consolidation can only really be completed by logging into your federal student aid account at studentaid.gov. There's a sort of a portal within that. Again, through the Savvy instructions, it links you right to it. It takes about 10 minutes or less to complete. again, have all those instructions laid out for you. Your loans are sort of pulled in. You go sort of screen by screen, submit the consolidation application, right? So that's unfortunately, we aren't able to submit that on your behalf. It's only processed through your student aid account. Okay, let's see. All right. So, saying it's forced forbearance last year for 12 months. I was put into it as well and wasn't on save. All right. So, you know what? I'm going to say it again. I'm going to want our support team to look into exactly what's going on. One of the things that they're going to be able to look at is your student loan data file, which will show them exactly what the status of those loans were. It'll also show them what your true PSLF count should be, and they will be able to dig into this and figure out what's happening. So don't worry. If you had 119 credits certified at one point, I assure you they did not go anywhere. And so there either might be an issue with multiple loans, or they are simply saying that because maybe you were placed into a forbearance unknowingly or not, that the months in forbearance are not counting. That doesn't mean that your qualifying payments are credits are zero. It just means that you need to certify. Okay, again, you likely will need to submit another employment certification form to certify those credits through current. All right. So it doesn't mean that you stopped gaining eligibility. All right. If you file for bankruptcy, does that mean you don't have to repay loans, or are they exempt from that? You know, I will say this, I've seen it differ from case to case, depending upon the bankruptcy situation. I am not a bankruptcy expert or attorney, and I would consult with your bankruptcy attorney or a lawyer if you have one, because there are certain scenarios where I've seen them be discharged through bankruptcy, but others where they are not. Most often where they are not, to be honest. If you are you know potentially pursuing that path, you would want to make sure that you get a concrete answer on that based on your financial situation from probably a bankruptcy attorney or lawyer. All right. Someone asked, if your child is still in school, do I need to consolidate my Parent Plus loans now since he has not completed school yet? So unfortunately, uh, those loans, okay, Lillian, you can try to consolidate them and see if you will be able to through your studentaid.gov uh, portal, but likely you will not be able to consolidate them until they go into repayment. And while he's in school, they are not in repayment. They go into repayment when he graduates. And unfortunately, if he's graduating after July 1, it may mean that you miss that cutoff. So that's why I would say try to consolidate them now. If you are unable to do that, the reason being is because of the fact that they have not entered repayment status. And unfortunately, there's no way around that or to change that. And if you need help or have questions, please reach out to our support team. Um, all right, someone asked if we have only, this is Raul, if we have only one federal loan and one Sallie Mae private loan, we can't consolidate, I assume. Does this mean we will not be able to consolidate going forward? I also saw there was a new cap at 67K on Parent Plus loans going forward. Is that correct? Okay, so if you have one federal loan, um, now I'm not sure if that's a Parent Plus loan, that federal loan, but if it is, you're able to consolidate that one loan. You are able to consolidate a single loan, absolutely. It happens all the time, more often than not. The Sallie Mae private loan, completely separate, and you can't consolidate that with your federal loan. Private loans are unfortunately not going to be eligible for any of the federal repayment forgiveness benefits or whatever, anything we really talked about here today. They're completely separate. So, sort of you have to deal with that Sallie Mae private loan. I have the same Sallie Mae private loans, been paying them for 20 plus years. And unfortunately, there's not many options when it comes to private loans as far as repayment and things like that. But on the federal loan, if you have a Parent Plus loan, you can absolutely consolidate, and you would want to consolidate just that single loan. And you'd be able to qualify for, an income-driven repayment plan should you complete that consolidation before, July 1. Now, as far as the new cap on Parent Plus loans going forward, yes, you're absolutely correct. And I believe, I'm going to pull up everyone stay here for a second. I'm going to pull up the exact uh, limits. I have them on another slide. Let me see here. All right. So we are looking at there's new borrowing limits across the board, unfortunately. Okay. All right, let's see if this screen will show up for you guys here. I'll share this instead. All right. Okay, let me share my screen. So this is just for anyone interested. Hold on. All right. Okay, this is a look at the changes in loan limits. So they are eliminating the Graduate Plus program altogether. Okay, the Grad Plus program is actually the reason I was able to afford grad school. It basically allowed you to take out an unlimited amount of federal student loans to attend graduate school. Um, and those would have been unsubsidized federal loans. And that program is being eliminated entirely starting July 1. So if you were in the middle of your graduate school education and had grad plus loans from your first year and were planning on relying on those going into your second year, um, you are going to have to think about how you are going to finance that education. Obviously, there's not financial aid like a FAFSA for graduate. And so this is going to be a really tough reality for a lot of borrowers who are mid their education, but something for many people to consider when it comes to whether or not they end up going back to school. All right. For graduate loans in general, they're putting a yearly cap of $20,500 in place and an aggregate lifetime cap of 100K. So you can't take out more than 100K in loans. Professional loans like medical school, law school, there's a 50K cap now per year, 200K lifetime. And then for Parent Plus loans, currently there's no annual cap. However, starting July 1, you can only take out a max of $20,000 per year and a lifetime of $65,000 per child. All right. So, obviously, again, the federal aid and or, loans are probably no longer going to be able to cover the full cost of attendance at many institutions, right? So you'll see borrowers who are forced to look at private loans, institutional aid, scholarships, out-of-pocket payments, things like that. And in the coming months, we are going to be actually introducing a sort of a whole college planning part of our tool, where we will help anyone who is at any point in that process, right? Whether they have a kid going back to school or kid going to school for the first time, they're trying to go back to school, wherever you might be. All right, maybe your child is still in middle school, right? And you're thinking ahead, or maybe you are, sort of mid parent plus loan, right, on someone in college to help you navigate through that. All right, let's see. Where'd my Q&A go? Okay. All right. Okay, Lynn asks, can wages be garnished if you work in another country as you have dual citizenship and are employed by a foreign employer? Not there yet, but wondering if the garnishment would follow you globally. That is a good question. I do believe it would only be an American company that is legally required to process that garnishment. Um, so you would be able to, if you worked abroad for a non-US company, likely avoid that. Um, However, you may experience another type of involuntary collections, which is tax refund garnishment. So basically, any tax refund that you would get when you file your taxes immediately goes to the Department of Education until that loan is repaid. Now, again, if you're working, internationally, right, for an international company, you may not be paying U.S. federal income taxes, right? So that may be, null and void. I would say this, you now have a period of time with wage garnishment on pause. The goal should not be how do I run out the clock on wage garnishment. The goal should be this is almost like a blessing of a period where uh your loans are in default, right? Or if you know they're in default, right, they would be subject to wage garnishment. But since that's now on pause, what can you do to bring those loans back into good standing? Because the defaulted loans are doing more than just obviously subjecting you to potentially wage garnishment. They mean that, your credit score is getting annihilated probably, and will continue to do so the longer that you remain in default. It means you are not able to access any other U.S. federal aid, whether that's coming from loans, home loans, mortgage, and financial aid. Um, it means you're not eligible for any forgiveness or repayment programs. It can sometimes mean the forfeiture of any license, federal or state licenses that you may have as a result of that. Um, and I would say you have the opportunity to try to bring that loan back into good standing. All right. So there are two ways to get out of default. You can either consolidate. This is sort of the get out of jail free card. You can consolidate. If you're in default right now and you consolidate your loan or loans, okay, as long as you haven't consolidated before. If you've already consolidated the loans, you can't consolidate twice. But if you're in default and you consolidate right now, you go into your studentaid.gov account, submit that, it will automatically bring your loans back into good standing, automatically. However, it will remain on your credit report, okay, as default. The second option is you pursue what's called loan rehabilitation. This is a 9-month process that you have to set up with the Department of Education Collections Agency, where you are making, or you basically are committing and making 9 consecutive payments on those loans, okay, under the agreement that after you've made that ninth payment, the loans will be rehabilitated, okay, and then they'll be brought back into good standing. You will have access to future aid, right? You'll be able to enroll in IDR. You'll be eligible for PSLF, the whole 9 yards, okay? You can only do rehabilitation once, just like you can only consolidate once. So um, that's just something to be aware of. A lot of the conversations that our team have with borrowers are, should I do rehabilitation versus consolidation? The pro to rehabilitation, even though it takes 9 months, okay, is that it is removed from your credit report, that default reporting, and that the damage may, as far as the credit score drop, may not quite bounce back as you would want, but it is removed. So there are pros and cons, right? If I would say if wage garnishment was still in effect right now, many borrowers might not have the luxury of 9 months of loan rehabilitation before a wage garnishment starts, right? And that could maybe be even more punitive. So we can help you to sort of weigh these decisions. Okay, let's see. Is the new payment plan coming in July? Is that a good program? Well, all right, I might be able to help assist here as far as explaining this. For those that are still, I will share my screen in just a second. Uh, so the wrap plan has pros and cons. I'm going to see if I have a better slide to help outline what this looks like. Uh, okay. So, all right, let me share my screen here. For those who are still sticking around and just happen to be interested here. Okay. Give me 1 second. Alrighty. All right, if you can see that. Okay. So it's going to calculate monthly payments differently than how monthly payments are calculated right now under IDR plans. Instead of it being 10 to 20%, okay, of your discretionary income, it's going to look at 1 to 10%, sort of a sliding scale of your total adjusted gross income. So your total adjusted gross income is likely going to be higher potentially than your discretionary income, first of all, okay? But it will be a sliding scale based on what that income is. There will no longer be a $0 monthly payment amount option. So even if you are unemployed and making nothing, your minimum payment will always be $10 a month on that plan. Okay. You'll be eligible for IDR forgiveness after 30 years. All right. The wrap plan is PSLF eligible. Okay. After 10 years qualifying employment, the whole 9 yards. Some of the benefits here, it does have interest protection. So unpaid interest is canceled monthly if you make your payment. Okay, so that's a good thing. So that prevents the balances from ballooning. It has a principal guarantee, so it will make sure that your balance decreases by at least $50 a month. Now, that's huge, right? Because I can't tell you, and I'm sure many of you can relate. I mean, I've been paying on my loans since 2011, and my balance has only increased, right, because of interest. So to be able to have, be in a repayment plan where I'm guaranteed for it to actually decrease, and I feel like I'm making a dent, and not, paying triple what I took out, is a big deal. Parent Plus loan borrowers, Parent Plus loans that are taken out after July 1 are not eligible for RAP or any IDR. Okay. Now, RAP is going to replace Save, okay, right? Save's ending pretty soon. The Pay Plan and ICR. Pay and ICR are being phased out by 2028. So you'll have some time if you're on those plans, okay? But those are ending. So it's replacing all three of those. Now, for anyone who's been paying close attention, there's one remaining IDR plan that's not listed there, right? If RAP's replacing Save, Pay, and ICR, what about IBR? Well, IBR will remain. Okay, so it will remain in place for existing borrowers, all of you. Anyone who takes out a loan after July 1 will only have access to RAP or the standard plan. All right, so RAP is going to be the only show in town. But for all of you who have existing student loans, right, you will be able to choose between RAP or IBR. Why is IBR remaining and Pay and ICR are going away? Well, IBR was also written into law, okay, which means it can't just go away like the others, right? And so therefore it will remain in place. And as I mentioned earlier in the presentation, it's actually the eligibility requirements have recently been expanded and more borrowers are now eligible. So you don't necessarily need to make the decision right now, right? And you actually have a couple of years before you're going to need to decide RAP or IBR. And when RAP, comes about in July, you'll be able to go through your Savvy account and simulate and see what that monthly payment would look like on RAP. Okay. Generally, it's going to be an increase. I mean, compared to the save plan, okay, it is going to be an increase, right? But there are certain positives here, I think, right? Like the principal guarantee, the interest protection, that might be to the advantage, especially of those who are not eligible for PSLF, right, and forgiveness, and are actually trying to pay this down, right? But in reality, it will be the only income-driven option for anyone who takes out a loan after July 1 of this year. So, I mean, just to highlight again, new borrowers, right? These are people who are taking out loans post July 1. They are automatically under the RAP rules. That's the default IDR option. Or they can always choose to remain and pay their loans on the standard plan. Existing borrowers, all of you who don't take out new loans after that date, can stay on their current plan through July 2028, and then you'll have to choose either RAP or IBR. And then if you have both existing loans and you're planning on taking out new loans after July 1, all of the loans, old and new, will fall under the RAP rules immediately. Okay, so this is something you're going to want to keep in mind. Even if you have loans right now, if you plan on going back to school and taking out loans after July 1, you will then be considered a new borrower and all the loans will fall under that, fall under the new plan. So for some borrowers, RAP might mean higher payments and a longer road to forgiveness. For others, the interest protections, right, and principal reduction may offer real benefits. The value of Savvy, right, is we're going to be able to help you compare your options before you make a move. All right, so hopefully that kind of helped explain RAP a little bit. Okay. Does RAP do anything for the 15 years of interest already on my loans? Unfortunately, not, Lynn, and I am right there with you. Yeah, unfortunately not. That interest is pretty much as good as part of your balance at this point, right? Unfortunately, the interest capitalization is truly one of the most egregious parts of the federal student loan system, and the way that it capitalizes. And there's no reversing that, unfortunately. But going forward, right, there at least is a way to prevent it from increasing, and it's felt like that has been impossible to date. All right, here. Any other questions that I can help answer for those of you who are still around? Okay. How do I know if the company I work for is eligible for PSLF? This is a great question. So, well, a couple different ways. One, if you want to Google, or you can actually, if you want to type it in on the Q&A, I will maybe be able to tell you right now, just based on the name or off the top of my head. But so if they are not a registered 501c3 nonprofit, okay, and usually that is determined by what's called their federal EIN number, all right. If C4, 501c4s, 501c5, like those don't count. It has to be a C3, okay, are all eligible, and any government institution. Okay, so let me give you 1 second here. But I believe Lehigh County Authority would be considered a government employer, but I'm going to confirm that for you. Um, but the best way to do it is when you're going through the Savvy tool, actually, and you get to that employment section, uh, you can type in Lehigh County Authority, and it should appear in that. There we go. I'll share the employment section. It should pop up from our database and you'll be able to select it. So when in doubt, the Savvy tool will show you, right? What state did you work in? What was your employer's name right here? Okay. And that's where you'll be able to verify. Uh, but from my understanding, and I'm going to do a quick search right now while we're still here, James. Okay, let's see. Lehigh. That sounds pretty close to what the questions are. A government employer to me. All right. Let's see. Lehigh. See. Okay. Yep, that is correct. A nonprofit institution, public nonprofit. You're good to go, James. All right. Liana asks, what if I have 10 years of service and want to get a new job? Totally fine. If you want to get a new job, you absolutely can. If you are wondering where, if you think, okay, after 10 years, I've reached, that 120, right? You just need to make sure, like, let's say the new job you want to get is not a qualifying nonprofit or government, right? You need to make sure that you are currently and actively working at a qualifying employer when you reach the 120 and when you receive that forgiveness. And this can be the toughest part for a lot of people who are, I mean, they're literally like down to the down to the months waiting to be able to retire or leave their job, but they can't because they're waiting on their PSLF to be processed. You cannot have left that or retire, right? Like, so let's say you retired last year, but for the 2 decades before that, you worked for a qualifying employer and you had made payments that whole time on your direct loans and on an IDR plan. Once you retired, right, you can't receive PSLF. You would have to go back to work at a qualifying employer, make a payment, submit an employment certification form for them to then trigger that forgiveness. So you just need to remain at you can switch to another qualifying employer, but you need to remain at a qualifying employer and be employed at the time you reach 120 and actually receive the forgiveness. And those can sometimes be several months apart. By the time, you might get the congrats, you've reached 120, you qualify for PSLF, and then when your loans are actually fully discharged, can take upwards of a couple months, depending upon what sort of batch of forgiveness processing you're in. All right, Sharina asks if I apply for an IDR now due to previously being on save, can I reapply again in July when RAP is available, or do I have to stay on an IDR for a year before I apply for a new one? This is a great question. So, Sharina, you can absolutely switch into the RAP plan in July. You can actually submit the IDR application, okay, as many times in a year as you want to. All right. And I'll give you some examples why. Okay. One, like you just mentioned, right? You find RAP is actually going to be a better monthly payment for you. And so you'll submit a request to switch into the RAP plan. It's the same application. Another reason why you may submit the IDR application again, well, So let's say I submitted it last month based on income documentation, right? And then a month later, we're sitting here now and I've been fired, right? I'm currently unemployed. Well, I don't have income anymore. And so what I would want to do immediately or as soon as any decrease in income happens to me, okay? Maybe you got a salary cut or whatever. Anytime your salary goes down, okay, and you're on an IDR, the first thing you're going to want to do, I mean, you can go back into Savvy and put that what that new number is, but we can resubmit your IDR application and what it's called request to recalculate your monthly payment based on changes in your income. And so, I mean, during COVID, we helped millions of people do this, where overnight they lost their jobs and had no employment. And so we resubmitted their IDRs, right? And we're able to get them on a $0 IDR plan. And remember that $0 IDR plan, if you're pursuing PSLF, each one of those $0 payments counts, right, as a qualifying payment credit. And even if, let's say, in the case that in the example I mentioned, last month I submitted an IDR based on my income. I got fired, right? So this month I resubmitted it and I qualify for a $0 monthly payment plan. I that locks that in now for 12 months, right? So it supersedes the past one. So that 12-month clock starts again. Even if I got a job tomorrow for $300,000, I won't have to do a thing. I will be locked in and set on that $0 plan for 12 months. That's the beauty of it, right? So you want to make sure that you're able to take it, I would say take advantage of any decreases in your income or increases in your family size, right? If you have a dependent, that's going to lower it by $50. But you can submit it as many times as you need to um, in order to be on the right path and have that right payment amount. All right, when consolidating federal loans through studentaid.gov, will that affect your credit score? No, it will not affect your credit score. However, it will create a new loan on your credit score and show your other previous loans. So let's say you have three federal student loans, right? Each with balances and interest rates. What they'll appear once they've been consolidated is they will appear as paid in full with a zero balance, and now you will only see that one consolidation, that total of those loans. So it might appear as a different loan, but it does not impact your credit score, and it does not take into account your credit score or check your credit score in order to process it. It's not like a refinancing, like you would for a private loan. Consolidation is basically a free federal process by which you are creating what's called a new direct consolidation loan. The primary reason to do it is because you have a non-direct loan, right? Maybe one of those older FFEL loans or a Parent Plus loan. But otherwise, if you don't have those loans, I would be very careful about consolidating just for the sake of, well, it's much easier to just have one loan instead of four because depending upon if those loans had different disbursement dates, payment histories, etc., um, that the consolidation may impact how much credit you get when they all get consolidated together. And the consolidation becomes a weighted average of those balances and interest rates. So again, depending upon those loans, right, that could impact it. If you and in that scenario, you have a choice. You don't actually need to consolidate. You're sort of doing it to effectively just consolidate multiple loans into one. For Parent Plus loans and for FFEL loans, you need to consolidate or you're not eligible. So you don't have a choice, right? But for those who are just like thinking consolidation could be a means of just tidying things up, I would encourage you to talk to us before you do so because you may end up messing up your progress towards forgiveness, potentially increasing your interest rate, and extending the sort of the timeline horizon on your loan in general. Okay, let's see. Raul, I'm going through the consolidation now on studentaid.gov. Love this. All right, this is awesome to see. And when I select IDR, I get a much higher monthly payment than the set repayment period. The IDR costs less over the long term, while the second nearly doubles the total, but not sure which of these I should choose now. If I choose the standard now, can I switch into an IDR once loans are consolidated? Absolutely. And actually, this is a great thing I'll point out. So when you go through the consolidation application online on studentaid.gov, part of that process of consolidating, they require you to select a repayment plan, right? They want to make sure you've got a responsible means of repayment once the loan's been consolidated. If you actually select an income-driven repayment option, it will then force you to link to your IRS account to try and establish a direct pull of your income, okay? And you do not want to do that, all right, for a variety of reasons, okay? But if you just were to select the standard plan, even though it's maybe $1,000 more a month, okay, it will let you go right through and absolutely, as soon as the consolidation is complete, we'll get you on the right IDR, right? But I actually, I explicitly tell people who I'm walking through that, choose the standard plan. They're like, are you sure that's a lot high? I said, yep, absolutely, because it's just going to let you pass right through without requiring you to attach or link any of your income or IRS account, which oftentimes doesn't work and slows down the application itself. But also, you don't want to establish that because it means that they're able to detect and pull that income in automatically. And you want to have control over whether or not they are doing that. You may want to use a pay stub instead of your tax return. And so we've discouraged borrowers from establishing that link for their own protection. So yes, Raul, click the standard, keep going through, and then as soon as while the consolidation is processing, your loans will be on an administrative forbearance, so you don't have to make payments, right? You'll get notified when the consolidation is complete, when your next payment is due, and then that's when you'll come back to Savvy and we'll get your IDR submitted. Okay, Lynn says, waiting for Save forbearance to end and then we'll go on a new plan. No longer have the job of when Save was applied for and working independently, but at a much lower salary. Not making payments due to forbearance. Should I wait for the Department of Ed to advise as to when forbearance ends? So, Lynn, this is where you can use the Savvy tool to simulate what's happening, right? So, if your income has decreased significantly, okay, since you enrolled on in Save, right? And that salary, is much lower, then, you on another IDR plan, right? Maybe if it's IBR, pay, ICR, right? I'd be curious to see what based on your current income now, okay, what you'd qualify for, right? And if it is if it's as low as a $0 monthly payment, right? Then you are absolutely more than welcome to switch now. Okay. It's going to be one of those things where they're likely either going to move folks over automatically. And in order to do that, they will have to refer to the last income documentation that they had, okay, on file when they applied for the program. And so if you're able to figure out now, well, you know what, I can qualify for actually a pretty significantly low payment, and I can get myself into another plan now, I would say do that now and avoid the headache that might come. Especially if you are pursuing public service loan forgiveness. I'm not sure if you are, but then you can start resuming to make those payments. But if it turns out that, even with this lower salary, that the monthly payment amount is still not going to be something that you just can accommodate right now, then absolutely remain in the forbearance. All right. Again, my perspective on this is when they advise that it will end at some point, right? And it might be sort of less of a headache, especially again if the plan you're moving into and that payment amount is something you're super comfortable with, for you to be able to do it now versus sort of fighting the crowd of 7 other million Save borrowers who are trying to attempt the same thing at the same time, right? So hopefully that makes sense. But it's all going to come down to, obviously, you've been paying $0 on the forbearance, right? So nothing really beats that. So it's going to come down to what, that new monthly payment would look like, right? And maybe that gets reevaluated when RAP gets introduced as well. And when it does, we're going to communicate with all of you and let you know, hey, come back if you want to take a look at what that income looks now. So think of it as sort of like you've got the ability with these IDR plans and the applications that you can submit so easily through Savvy to be agile from plan to plan, right? You can move from IBR to pay to back to IBR, right? If you want to standard, at any point in time. Okay, Kim asks, what if my husband and I file taxes together? So if you are married filing jointly, okay, uh, the under the IDRs, they will look at your joint income, which I know sucks because, oops, excuse my French, but it's oftentimes higher if it's looking at two people's incomes compared to one, right? Um, so, and I am not a tax expert, and so I'm not going to advise anyone to consider filing their taxes differently because I know that there are plenty of advantages to, being married and filing jointly. Um, but something to keep in mind when an income driven repayment plan looks at that income, if the taxes are filed jointly, it's looking at the joint income. Now, if you are married filing separately, it will look at just your income. But again, like I am in no way advocating for that. That would be something you'd want to talk to a tax expert about. All right, there's about 18 of you still left on here. I'm thinking some of you must be consolidating, which is great. I'm glad we're getting some of you through that in real time. Raul, I will tell you, if you're there listening, the last page of the terms and conditions, where you keep scrolling and scrolling, it's going to make it sound like you are signing over your firstborn child and all the rights. It seems and looks very intimidating, but it's not. So don't let that slow you down. And hopefully, before we wrap this up, you can let us know that you've successfully completed that. Also, when it asks for two references, two references to potentially contact, they in no way, shape, or form ever contact those people, just so you all know. So I think mine was my grandfather who may have been deceased at the time, but he was still on my federal student aid account, his information. So it's really not a big deal if you don't know the exact phone number or address of the person. Oh, Raul, that's great. Okay, good. So you got it in. That's a success. Uh, this means, again, we should have plenty of time for that consolidation to process. You'll be able to check back in on the progress of that on your studentaid.gov account. When you submit that application, there's a 10-day window from now until 10 days from now that they basically give you in case you won't say, oops, I didn't mean to do that. All right. So they really don't effectively start processing until 10 days from now. And then, you can check back in on your student aid account where it'll show, in progress. And then you should get updates, notifications from your servicer when that goes through. Don't be alarmed or actually don't think, hey, did my loan just get forgiven? When you log into your existing servicer account or, whichever one you have now, and it shows that your balance is zero, paid in full. Fortunately, it doesn't mean your loans were forgiven. It means that's the consolidation. So it sort of pays the old loan out, and then it consolidates into the new one. And unfortunately, had been the bearer of bad news to many borrowers who called very excited, thinking their loans had just been forgiven, when in fact it was just the consolidation going through. All right. Kim, if your husband chooses the standard payment, they do not look at his taxes. They are just looking at how much student debt he has and uh, that payoff timeline. So when it comes to the standard plan, right, there are sort of like three variations. There's the true standard, which is 10-year payoff. It's going to be same payment amount each month for 10 years based on how much student debt you have. Excuse me. Then there is standard extended, which extends 10 years to, I believe, 20, 25, or 30 years. Okay. And that's meant as a way to help lower the monthly payment a bit, right? So it just extends the timeline out, so therefore lowers that monthly payment slightly, but again, still based on how much debt. And then there is standard extended graduated, which while also extending it, slowly graduates the payments over time. So it starts the payments a little bit lower early on and then graduates. Either way, all three of those, okay, are all considered part of sort of the standard plan, right? I was on graduated for a while, again, because that was the one that gave me the lowest monthly payment. But this was before I knew IDR plans existed, right after I had graduated college. But Yeah, so you should be able to see all of those. And again, for someone who doesn't have a very high debt to income ratio, if you have under 5 or 10 grand in student loans, it's very likely that on a standard plan, your monthly payment amount could be lower than it would be on an income-driven repayment plan, right? There's sort of a point at which, based on income and that debt amount, where those might actually switch. So that's why we want to show you all the options, right? Um, and that's, in that instance, especially if you're pursuing PSLF, you'd likely have them paid off before you'd reach the 10 years. All right, guys. Well, for those of you who may still be on here, um, let's see. Okay, Lynn, I'm going to answer your question, but then I have one favor for all of you guys. Let's see. When Savvy asked about my employment, I know you want info on my main 40 hours job, which is PSLF eligible. Do you want the info for my second job? I work nights and weekends as a dispatcher for a tanning company. Well, Lynn, you are very busy. So if your primary employer is oh, let's say that I should say this. Was there ever a point in time where you were not working for your primary employer and you were only working as the dispatcher? Basically, what I'm trying to say is, could that dispatcher position, um, uh, oh, you know what? I thought you said for your town. Dispatcher for a towing company is probably not going to be nonprofit or 501(c)(3, so you don't need to put that. I was thinking it was another qualifying job for public service loan forgiveness. No, you can just stick with your current employer. Okay. All right, give me 1 second here, guys. I'm going to see if I can. I'd love for, before you guys hop off, to collect. I hope that this was helpful. I always end up staying on so much longer than I intend to, but I find it's kind of helpful to just be able to, for those who are willing and able and want to kind of just talk it through, I'm here to do so and answer those questions. I want to be able to share with you all a link. All right. We are trying to collect some more testimonials about Savvy and the experience. And Uh, of course, it's always hard to get. Should take about 2 seconds. But if you wouldn't mind, let's see. Let me get this right link. Sorry, guys. Okay. All right. All right. Come on. I'm going to find this link for you. Oh, no, it's not here. Well, if you have to hop, hold on. Let's see. Let's see. Oh, all right. If I can't find it in the next 30 seconds, uh, I will give up here. Hold on 1 second, guys. Bear with me. All right. Let's try another link. Trust Violet. All right, we got it. Okay. If you guys wouldn't mind, before you hop off, if you are so inclined, I'm going to post this in the chat. That is a Trustpilot link. We are just trying to collect more feedback and testimonials from borrowers who've interacted with us and benefited from, whether it's been a webinar or tool, anything like that. It helps other borrowers to see that, especially within the union community. And so, before you hop, if you are so inclined, and there's also another one, if that doesn't work for some reason, uh, you can also use this as well, and I can put that in there. Any last questions before we wrap things up for the last few souls standing here? I'm happy to answer. All right. If not, here is the This is the one that I created originally. Oops, to share your student debt story. Um, and this one you can sort of a little bit different. You can even record a video, voice, what have you. But this is sort of almost like I want to hear about your story rather than your experience with Savvy. So these can sometimes help really make other people more comfortable about talking about their student loans and especially when uh, you know, I would say expertise and trust is so hard to come by these days. Can make the difference between someone deciding to come and engage around their student loans and not. So, anyway, I will let all of you get on with your evening. Let's see. Yes, Kim, with the premium, can we talk with someone? Yes, you can. Yep, you absolutely can. Um, 100%. And guys, don't forget about the inviting three friends or family, right? With those email addresses. Again, the people you invite don't have to do anything, which is unheard of. We all know how referral things work, right? But you get that 50% off coupon code um, instantly in your inbox. It can only be used on the Essential, not the Pro, by the way. But we are going to be coming out with a family plan, I think in the next probably 6 months, hopefully, where, it would be the ability to sort of, if your husband has loans and maybe you have a son or daughter, or you name it, but sort of tack on multiple people into a premium plan. But for now, this is for sure 25 bucks and 70 cents is the cheapest probably in the country for any Savvy user after that 50% off. So, um, anyway, I hope all of you got as much help as possible. We got 15 folks still hanging on strong. Please, if you guys get a chance to fill out either one of those testimonial links, one is more about Savvy, one is sort of about sharing your student debt story a little bit. Um, I would appreciate it. I hope that this was helpful. Please feedback to SEIU. Stay involved with your union. We're going to be doing a lot more of these in the coming weeks and months because fortunately things are only going to get more chaotic. But I hope that this can be a place where you can come and get those questions answered. I'll always be here as your chief borrower advocate. So thank you again to everyone and have a great rest of the evening.